Well, this is shocking. Millennials just got screwed again. Mostly thanks to this haircut. No, but with interest rates going way up, millennials have been priced out of buying a home once again. Now, the Washington Post just released some really interesting fun facts about home ownership that I didn't know about before, about how the pandemic changed home ownership forever. Like the fact that between 2019 and 2021 was a period of growth where millennials saw the highest rate of home ownership ever, according to an analysis of new data from the Census Bureau. For the first time in almost 10 years, the average age of home ownership actually dropped. And this is partially thanks to the fact that we were asset rich, we had cash, we had savings, we had stocks, we had crypto, Bitcoin, NFTs, stimulus checks, and relief programs. But this year, in 2022, the market flipped. As we saw home values explode, we saw interest rates go way up, and of course, massive inventory shortages. Now this year, in 2022, the median age of home buyers buying a primary residence has actually gone up to 53 years old. They compared millennials to every other generation that came before, including Gen X, baby boomers, and the silent generation between the crucial ages of 25 to 34, and they found that roughly 27% of millennials could say they own a home today, as compared to 40% starting rates for every other generation that came before. And what this ultimately means is that millennials are lazy, no good, two-timing, parent-milking scoundrels. But also because before millennials came around, houses cost like 10 raspberries, and also because millennials are dubbed as the unluckiest generation of all time. So I want to share with you some super fascinating statistics about home ownership that you never knew about. It's going to be super interesting, so let's get into it. Hi, my name is Andrei Jikh. Hope you're doing well. Come for the finance and stay for the real estate and the drama. And you know there's going to be drama anytime there's real estate in a news publication, because that's when you get people of all ages and different generations to point the finger at each other over why things are the way that they are. So grab your popcorn and let's talk mortgages. First, did you know that the word mortgage comes from the old French language, which means the death pledge? That's right, you're going to be paying off your mortgage until the day you die. No, I'm kidding. It's called that because as soon as the obligation or the debt is paid off, it comes to an end, or it doesn't, in which case, off with your head. All right, so check this out. When the older generations were moving out of their parents' house and into their first rental, that's when millennials, by comparison, were still at their parents' house. And when the older generations bought their first property, that's when millennials finally moved out of their parents' house and into their first rental at roughly the age of 24. So there's a noticeable delay here in our generations. This is the lowest level of first-time home buyers in the last 4 decades. We have dropped from 34% down to 26%. Now, this is really interesting because you might be wondering, how is it that last year was such a good year for millennials to buy a house, but not this year? Again, partially because we were asset rich last year, and even though property values went up last year and this year, you have to remember that interest rates were artificially kept close to zero, which made it really affordable for a lot of people to get a loan. When money was cheap to borrow, it created a ton of demand and competition for the reasonably priced home, which is why we saw the median home value go much higher. And now we're seeing this effect where people that already have a house have less incentive to list and sell their house just because they don't want to be priced out of the new market, and they would rather just upgrade their house instead. Check out just how much interest rates have an impact on the true cost of home ownership. This is about to blow your mind. Again, this is an example directly from the Washington Post. So imagine a house that costs $450,000 and you put down 20% or $90,000. That leaves you with a principal value of $360K. So that is the loan value. Now, obviously, when you make payments on your loan, it's not all going towards this principal value. In fact, a lot of it in the beginning is going towards the interest. And that's because of something called amortization, which is a fancy word for at the beginning part of the loan, a lot of the money is going towards interest. But as the loan gets older or matures, you can imagine a sliding scale that slides towards the principal value. So let's imagine that your loan is $360,000 at an interest rate of 3%, which is what you could get it for in July of 2021, last year. Well, if you did that, the amount in interest that you'd pay over the lifetime of that loan would equal $186 $436,000, which means the house that has a sticker price of $450,000, you're actually gonna pay $636,000 for. Now, the first time I learned this in high school, it sort of blew my mind because my brain couldn't understand how small of an interest rate means how much I'm going to overpay for a house. But that's when interest rates are reasonable at 3%. Let's scale it up. If the interest rate went up to 5.3% like it did in July of this year, then that $450,000 house, you would pay an additional $360,000 in interest payments only. That brings the total to $810,000. That is a scam. But it gets way worse because we could use November's interest rates. Believe it or not, some people managed to lock in a 30-year mortgage at 7% interest rates. That means that $360,000 principal or loan value at 7% over 30 years would cost $502,000 in interest payments only. You're gonna pay more in interest at that point than the value of the entire house itself. That would bring the total to $952,000, $450K plus the $502 in interest. That is pretty insane. And we're not talking about multi-million-dollar homes here. This is the median home value of $450,000. But this is exactly where we get into a debate though, because the older generation will argue, look, back in my day, I paid 18% interest. And that's true. It's also true that I don't know how to do a voice outside of Warren Buffett, and this is the best I've got, but it is true that interest rates went as high as 18% in the 70s and 80s thanks to Paul Volcker, their Papa Pal raising rates on them to slow inflation down. But also true back then, homes cost a lot less. And that's because income growth and home values had less time to diverge. And this is extremely important because back in the 60s, income growth was very much in line to home values. This is extremely important because after the 70s, when we got off the gold standard, that's when income growth slowed way down and that's when home values started to explode. This is not the true story though. The full story is not something I'm even seeing people talk about because it's all about exponential growth. You see, it's not fair to compare a small number to a big number and say that because they're both experiencing the same growth rate that everything's perfectly fine, because eventually it won't be, and here's why. If the median income is $45,000 a year and the median home value is $450,000, a 10% increase to both would mean a $4,500 raise for the 45K and a $45,000 increase to the home values. We are comparing $4,500 against $45,000. That is a 10x difference. That bigger number is growing much more meaningfully for that 10% than that smaller income number. There comes a point at which that bigger number will outpace the smaller number to the point where the smaller number is completely insignificant and mismatched. I feel like we're coming to that point if we're not already there. But even all of that is assuming that both incomes and home values are going to continue growing at that same rate. But even that is not true today. According to the latest data from BLS.gov, we know that from October last year to October this year, real average hourly earnings went down 2.8%. We also know that home values increased 11.4% year over year, according to the latest data from CoreLogic. So that means the bigger number here is growing, and not only is it growing, it's growing faster than the smaller income number, which is actually shrinking. Fortunately, despite the data, not everything is as bad as it seems, is what I'll keep telling myself. But seriously, millennials don't actually have to accept their fate because if anything, the pandemic created so many opportunities because we've had and still do have a huge worker shortage. Now more than ever, it is easier to find a job, especially because economists are considering the jobs market to be too hot and bad for the economy because skilled workers are really hard to come by and companies are competing for people's talents, which is why now more than ever, it's important to capitalize on those skills. And that's why today's sponsor is absolutely no one, but that would have been a great segue. Skillshare. Just kidding. But one major upside that we can't forget about is the greatest wealth transfer of all time, where something like $84 trillion will be transferred by 2045 from baby boomers to Gen X and eventually to millennials. And at first, it's going to be the Gen X that will inherit $8.9 trillion over the next 10 years, while millennials will inherit $5 trillion. But it's also estimated that by 2040, millennials will surpass Gen X, and by 2045, we'll inherit something like $27 trillion. So the moral of the story is be kind to your parents and your grandparents. But if you actually don't have anyone and you're not sure right now whether it's better to buy a house or to rent, before you watch any more YouTube videos about this, here's how you can figure that out all by yourself. So here is one of the most useful tools I have ever found on the internet, and it's called the Rent versus Buy Calculator from the New York Times. It is the most comprehensive guide on letting you figure out at what point it makes more sense to rent that house instead of buying it using some super simple information. Now, it can be a little complicated, so if you're confused on how to use it, let me just give you a quick walkthrough. So let's say I'm looking to buy a house here in the Las Vegas area where the median home price is $390,000. Next up, it's gonna ask me how long I'm planning to stay here. According to the National Association of Realtors, the median, not the average, but the median length of time that a person will stay at a house they bought is about 13 years. So I'm gonna put 13 years here, and then it's gonna ask me for the mortgage details. And the thing that hurts the most right now is, of course, the mortgage rate, which has reached 6.6% this month, which is really high, but that's what I'm gonna put here. Then next up, it asks you for the down payment details. Now, normally I would aim to put 20% down to avoid the PMI, but in this case, let's just assume that I was only able to get to 3% of the down payment, so that's what I'll use here. Then next up, it asks you for the length of the mortgage, which I'm gonna leave at 30 years. Now, next up, it's gonna ask you a super important question about what does the future hold? All it asks you here is if you could find a house to rent that is the equivalent of the one you wanna buy, assuming you were gonna save on your monthly payment, if you could invest the difference into the stock market, what is the opportunity cost of that money working for you to see if you could come out ahead? Super important question. So for home price and rental growth rates, I'm gonna put 4 and 3%. Now, obviously, I have no idea where these numbers are gonna go in the future, but I'm trying to balance out what is true today with what we know historically to be true, and that's reasonable to assume. Again, I'm trying to do this calculation for the long term, not trying to do it for the short term. So for the investment return numbers, I'm gonna put 8% here because that's how I like to invest my money. I like to invest the majority of it in the stock market, into the S&P 500, and in a normal year, it should pay 8 to 10%. But I'm being conservative here, but honestly right now, the stock market's losing money. So again, long term, it should be 8% though. There are no guarantees, except for the bond market, which right now, the 1-year bond is paying 4.7%. So if you're only comfortable putting the difference in savings into a bond at 4.7%, then you could put 4.7% here, totally up to you. Now for the inflation. Let's just put infinity right here. No, I'm kidding. Let's not put infinity. Let's put 4%. That's what I'm putting here, even though I know inflation is so much higher than 4%, but I'm hoping that in the mid-term, we can come back to 4%. In the long term, if we're lucky, maybe we can come back to 2%, but for now, 4% seems pretty reasonable. Next up is the taxes section. Now, for property taxes here in Nevada, for me, I'm paying roughly 0.8%, so I'm gonna put that here. And for the marginal tax rate, I'm gonna put 22%. Even though that's not my marginal tax rate, I'm just using the average. If you're not sure what your marginal tax rate is, just take a look at this chart, and wherever your income falls under, that is your marginal tax rate. Now, for the closing costs, for both buying and selling a home, I'm just gonna leave it at 4 and 6%. Now it asks for maintenance and fees. Now, homeowners insurance, I'm gonna leave at 1%. It could potentially be less, and utilities, because it kind of cancels out, I'm gonna leave this at $0. And for the HOA, I'm gonna put $100. And for additional renting costs, I'm gonna leave at 0. So in total, this gives me a monthly rent of $1,563. What this means is that if this hypothetical house that I was looking for $390,000 was listed in the rental market for $1,563 per month or less, then it makes more sense to rent it rather than to buy it. Already I can tell you without searching online, without looking on Redfin or Zillow, that this house that is almost $400,000 does not exist for $1,500 a month. It would be substantially higher here in the Vegas market, starting at least at $2,000, and that's if I'm lucky. So that is given this very hypothetical but very specific situation for this specific market, for this specific hypothetical house, and your numbers numbers would be very different depending on where you live, what you want to buy, and what type of market you're in. When I bought my first rental property earlier this year, I managed to get it at 2.5% interest and locked it in for 7 years. That means my rate is not going to change until after that 7-year lockup period. Now, I thought about it like this. This is kind of crazy to me. In order for my mortgage to be the same as it is today at 2.5% interest, the house today, if I was buying it again at these current rates of 6.6%, would have to be valued at 40% less than what it was when I first purchased it. Now, I'm definitely one of those people that thinks real estate is going to correct, but I don't think we're gonna fall 40% bad. That would be catastrophic. Maybe I'm wrong, but that's why I bought when I did at the rates that I did. And thankfully, I was able to find a renter for a small profit, even though it did take me a couple months to find one. But in the end, the interest rate on the loan and the tax savings were more than worth the purchase, and the extra income I get to make is just a little cherry on top. As always, have a wonderful rest of your day. Smash the like button, subscribe if you haven't already, and I'd love to see you back here on Monday, Friday, sometimes a Wednesday. Love you. See you soon. Bye-bye.